Welcome to Berman's Call. Thanks for joining us today. We're here to take your questions on stocks and ETFs. Here's how to reach us toll free, 1-855-326-6266. You could also email your questions in today, Berman's Call at bnnbloomberg.ca. Larry, good to see you.
Good to see you.
In person and not virtual today. Let's talk about oil and where it's at. West Texas, last I looked, 106 US a barrel. Do you expect the energy prices now to filter into longer-term inflation?
Well, so we had been talking about for the last couple of months, the front month contracts were elevated and the back month contracts were still relatively subdued. What we started to see late last week and follow through today with the elevated tensions in the Persian Gulf is that the back month's contracts now are starting to move higher. So I think we have a chart, but we may not. And it's showing the December futures contract. And what you can see is the back months are now a little bit elevated and breaking out of a trading range.
Are they at a spot where it's concerning? Do you think they'll continue to move up?
Well, so technically, if you're looking at a chart, you say, okay, we've had this trading range. We've had a big move up, and they have technically what's called a measured move. It's just an objective based on market behavior. So if we've been trading in a $10 range between $70 and $80, and things are relatively passive at the moment, if we're looking at a big move higher, this is not the right chart we're looking at here. So let's pass on that one. There we go. So when we're looking at this chart here, what we can see here is that crude oil prices traded in a bit of a range for the last few months. This is the December contract, between $70 and $80. Now, in the last few days, you can see it's clearly breaking out of that range, and we can estimate where it might go. So if the December contract's now starting to trade at $90 and $100, we've got to worry about higher oil prices for the rest of the year. And that's really what concerned me, because most of the geopolitical events tend to be measured in weeks to months. Mm-hmm. They're in and out. This one looks like it's going to be a lot stickier. Equity markets at the moment don't seem to care.
I was going to say they seem strong.
Because earnings have been fantastic. We've talked about that, I'm sure, in other segments on the network, that's become very, very clear. I think the markets will start to pay more attention to the geopolitical risks and that longer term price at some point. Today could be that inflection day.
I'm also wondering whether you see, as you mentioned, earnings have been quite strong, but when does some of those energy costs, preliminary energy costs, start moving into other things, transport for other products or other products that get made from that base oil?
No, an airline, as an example, a cruise line, they would lock in their forward prices for 6 to 12 months. So it'll matter down the road, and then it may not matter anymore. Okay. Right? Because the market will start to discount things. We've seen a couple of the airlines initially really, really weak. I suspect you're going to start to see weakness come in to some of those names that are really heavily influenced on their cost side.
A lot of exporters.
That can't pass through.
Yes.
Companies like FedEx usually have some kind of mechanism that if prices are above a certain level, they just tack on a premium to the service. So there's a number of different business models to mitigate shocks like this, but okay. The market will start to care.
Let's get back to earnings for a moment. Obviously, we've seen tech do really well. What's your overall take on earnings across the board?
So broadly speaking, okay. Mm-hmm. In particular, very concentrated, AI related, the big CapEx spend. It's been well covered, been phenomenal, but way better than expected.
So tech still standing out, and it's kind of an AI energy story so far this year.
Very much so. Broadly speaking, there's going to be secondary benefits to companies that are bringing AI in terms of improving margins, measured in years from now, not necessarily this quarter or next.
Where are you beginning to see that? Clearly, investors are looking at the hyperscalers to see what they're giving back. But where do you start to see that AI rollout give back in other sectors?
Yeah. So my industry, financial services, 5 years from now, will an AI be making the vast majority of investment decisions for the team? Sure. Does that mean I don't have to hire 5 new analysts and traders? Probably, right? But again, measured in time, not necessarily this quarter or next. So it'll come in to productivity. It'll come into earnings margins over time, not immediately.
All right. Let's take a quick break. We'll come back to phone calls and emails for Larry Berman. Here again is the phone number. You can give us a call as well as the email address. Larry will take your questions today on ETFs and large cap stocks. Back in a moment. Welcome back to Merman's Call. We are here with Larry Berman to handle your questions. We're going to start with an email from Evan. I'd like Larry's opinion on Cap REIT. It has been down, but I'm wondering if now's a good entry point. This would be in my taxable account for income and steady growth and hopefully a long-term hold. What does Larry think about the stock and the outlook for the REIT sector at the moment? What are your thoughts on Cap REIT and overall the REIT sector? Would you put money into that?
So you got to define it. Apartments were hot for a long time, and all of a sudden we were not letting as many immigrants coming into Canada. It's cooled off dramatically. We're seeing this in private apartment valuations. We're seeing this across the board. The condo market in Canada got absolutely obliterated the last few years. So it's working its way through the market. And as a value investor, I like to look for things that are cheapening up relative to things that are expensive. So this is on my radar. Haven't made a direct investment yet, but for the yield players out there, it's certainly coming into that sweet spot compared to where it was a year ago.
That being said, do you look for an upcoming trigger that would make you buy in because you know there could be a lift?
Well, I suspect we're going to go back to better structure around immigration compared to what it was, say, the last 5 or 10 years. So I think Canada is going to still grow dramatically in that perspective. And so, you know, timing it perfectly, you'd have to have some insight into what the federal government's probably thinking on that. And I don't have any particular insight into that. But you'd have to dig in that area to figure out when the catalyst might be.
So you're happy to take it at a lower level and just hold for a while?
If you can buy something at a good, reasonable valuation where if nothing happens, you're okay, then that's the time to really put your foot in.
Let's go to the first caller then. Sam's on the line. He's in Brampton, Ontario. Sam, go ahead. Sam, are you there? Okay.
I'm here.
Oh, go ahead. Ask your question.
My question for Larry is on XAI. For a long-term hold in a registered account, what does he think about it? And is this a good hold? Thank you. Thank you for taking my call.
Okay.
And I'll hang up and listen to you.
Thank you. This is an iShares high dividend.
Yeah, I think there's better dividend plays if you're looking at the Canadian basket than what iShares delivers. It's not a bad one. It's one of my least favorite. I think BMO does it a little bit better. And if you want to look at cost perspective, Vanguard's probably got a better solution there. So depending on your view, but I think the iShares is my least favorite of all the ways to play Canadian dividend baskets by way of ETFs.
That was Sam. Let's go on to Roger, who's calling from Frankfurt, Ontario. Roger, go ahead.
Oh, good afternoon, people. I'm calling on behalf of my daughter. She's 58 years old, wants to invest in AI through an ETF. What would be the recommendation that you would have for her, Larry? And if you could give me the ticket tape, I would appreciate that.
Thank you for the question. Are there very AI-specific ETFs you like?
I've been talking about AIQ. It's probably one of the first ones that sort of had a very direct, it has AI in its name, but really focused on the sector. Prior to this ETF, there were some robotics and some more, a bit more diversified. But this one, AIQ, is really a bit more focused on the sector itself. But when you look through it, Here's the thing. It's not a pure AI play, and it's better than most. But you're getting a lot of semiconductor chip exposure, right? Obviously, that's part of AI. But it's not necessarily companies that are utilizing AI, in their output. So you're getting a big mash of the big tech stocks in Canada, around the world, not in Canada, pardon me. But that's the one that I've been tracking and I talk about when I'm looking at the sector.
AIQ is where we are. Let's go to our next caller. Then we have Lawrence on the line in Barhead, Alberta. Lawrence, go ahead.
Hello. I'm looking for Dynamic Premium Yield Fund Series A.
And you just want to know a little bit more about it?
Yes, I'd like to know as much as we can about it. I have some of it, and the dividend is really good. I just want to know if it's secure.
Okay, thank you for the question. Dynamic Premium, can you tell me a bit about it?
Yeah, so they used a lot of derivatives, covered calls, naked put writing to generate income. And Dynamic does a great job at it, and I really like the team there at Dynamic. They've got an ETF version of this. So if you're looking to save a little money, an A-class mutual fund is going to be a little bit more expensive. So there's an ETF version of this that might be a little bit less expensive for you, depending on whether you're a do-it-yourself investor or not. The ETF may be more appropriate and gives you a very similar exposure to what they do in the mutual fund.
What's in, can you break it down a little bit more as to what is in it, and is there a comparable, or is this the one you like?
Well, I've talked about ZPay quite a bit as an ETF that does something similar that BMO has. There aren't a lot of comparables, and Dynamic's been doing this for a long time, and again, great team there.
Okay, that was for Lawrence. Let's move on to our next caller, Andy in Calgary. Andy, go ahead.
Hello to the both of you, and thank you very much for taking my call. Larry, I wanted to know your thoughts about Mosaic. I know that Mosaic as well as their competitors are down quite a bit from their highs. Is this a good buying opportunity here, and would Mosaic be a good way of playing that sector? I'm just going to hang up and listen to your wisdom. Thank you very
for the
much.
question. So this company does sort of agricultural commodities?
So fertilizer, effectively. And I like the sector right now. I think, this is such a key ingredient to the idea of the world's got this massively growing population. We need to feed the world. Fertilizers are a huge source of enhancing crop production yield. Obviously, with the dynamic in natural gas and the supply shortage coming out of the Middle East, there's some shorter term considerations, and that's behind some of the weakness in the last couple of months, certainly. But I like it here, and I'm nibbling on it, and I've added to my portfolio recently.
This is a U.S. company.
Yeah.
All right, that was for Andy. Let's go to an email next from Tony. I'm looking for a relatively safe haven for liquid funds. Larry had previously mentioned ZPay, which you did bring up again for this purpose. How would he compare ZPay to TPRFTD, active preferred funds? TPRF pays a 4.5 yield and has survived the most recent correction in March fairly well. Can you do a setup for those two?
A completely different risk profile. Preferreds compared to an option type strategy. So, it's hard to make a direct comparison
Okay.
in those two because they're very, very different risk buckets. I'm of the view, though, if you're a yield seeker, there's no one solution. ZPay, as much as I like it, isn't the answer. DXQ, which is the dynamic version of that itself, isn't the answer. I love differentiation of manager style. So whether that's a preferred basket of securities, single preferreds, if you're good at understanding the credit risk of companies, it all makes sense for yield-seeking portfolios.
Okay, that was for our emailer, Tony. Let's go to Paul's email. Hi, Larry. I just came across a number of Harvest ETFs on the TSX that offer dividend yields between 25 to 45%. So here are a few examples: LLHE, PLTE, TSLY. I often hear yields of 7 or 8% be called juicy. So how do you get to where these guys are in the 20% range? And these are the ones that you have to be careful about?
So they use a covered call overlay strategy to enhance the extra yield. And while I like that, you're giving up a tremendous amount of upside. We prepared a chart for this, and I'm not sure if we can show it here. But if you look at the underlying here, you can see that I've put the PLTE in Canadian dollars, the Palantir stock itself, and then the Palantir stock as if you were a Canadian dollar investor. So one in US, one in Canada. Here's what I want to point to. So in terms of the price change, you've got 38% over the last few years in the PLTE. In Palantir, you've got 111% return. But look at the total return. So you're actually doing worse in PLTE from a total return perspective, 106, as if you were to just have bought Palantir by itself. But as a Canadian dollar investor, you would have done a little bit better because Palantir in Canadian dollars, PLTE got you 106. So now it's about a composition of returns. It's that taxable, favorable, but you're now turning annual capital gains and distributions into current income. If you just bought and held Palantir, you'd have no tax along the way. So it depends, is this in a registered account? Is it in a taxable account? How active you want to be as an investor, whether it's appropriate or not. Those kind of yields are doable because the volatility in these stocks are absolutely off the charts right now. Not always going to be that way. So the yield is higher than it otherwise would be right now because AI is in play and Palantir's a big name in that space. Don't look for those returns to be repeated.
So is Palantir volatile most of the time or just in the last while because of the AI and defense pickup?
You know, listen, 2-3 years ago, analysts hated it, thought it was worth $5 or $8.
Yeah.
Today, they can't get enough of it. So nobody really knows these things. Right now, the sentiment is driving the money flow into this. I think it's crazy overvalued. I wouldn't pay that for it here, but it's tradable.
Let's get to another email, this one from Tom. I would like your opinion on HBIX, a Bitcoin ETF. And is the dividend sustainable? Where are you with Bitcoin? Let's take a look at this one in particular.
So same story here. This is an ETF that uses Bitcoin underlying with an option overlay strategy to enhance your yield. And if you're bullish on Bitcoin and price is low, you don't want anything with a covered call overlay to enhance your income. Right? If you're defensive and you want to be there and you want to extract income from it, then HBIX makes sense, perhaps, in your portfolio. But this is something that almost certainly, because of the way the volatility plays out in this space, is going to underperform in the long run versus just holding Bitcoin.
All right, we'll take a quick break then. We do have to get to Larry's educational segment. That's coming up next. Stay tuned.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. Larry wants to take a look now at the defense sector. What specifically are you looking at for investments?
I wanted to have some fun today. It's May the 4th, and I was a Star Wars fan in the day, and May the 4th be with you.
That's the first time I've heard it today, surprisingly.
So SpaceX is going to go public in a couple months, and it's apparently going to be $1.75 trillion. And when it starts to get included in these ETFs that play the sector as it goes public, it's going to end up dominating many, many exposures. If you own the QQQs, the NASDAQ apparently is going to roll this in the first week into their main index. And so you're going to have this very, very expensive asset in your portfolios. And while it's very exciting, story about going to Mars and SpaceX and exploration and mining in space, tremendously exciting. Don't think it'll be profitable for well, who knows, right? So not in my lifetime are people going to be living on Mars. But I'm told, Larry, you're an old guy and you don't get it, right? So maybe that's the case, and I don't have the DNA and imagination for this space. But when you look at it, there's a couple ETFs here. So you've got the ARC-X. So this is one, Cathie Wood. It's been around for a long time. This is about a 5-year look back here, just celebrating the anniversary. And you can see it when we compare it to just the defense industry, that it's actually underperformed. When you look at the defense industry. Now, the defense industry really took off in a big way. Started to originally around the Ukraine-Russia war. There was a little pop there, but it didn't last. That was more temporary. This one is got some legs to it for sure. When we look at what's happened here and of late, but not materially so, right? Because when you look at those charts and the total returns there, you kind of scratch your head a little bit. Because when this war ends, and Trump's the president that's ending all the wars in the world, starting one too, but ending all the wars, you wonder how much is priced in here. When this SpaceX gets into it, you're paying an awful lot for this, and I would just offer some caution here. But I think it's interesting, it's timely. I know we're going to get a lot of questions in the next few months around the SpaceX.
Do you look at SpaceX,
public.
then you look at it as a defense company, or do you look at it in other sort of as a tech company? Where do you actually put SpaceX?
I listen, what's the IRR? What's my expected return? That's how I think about it. I don't care what bucket it falls in.
You don't care what sector it's
I was like, how much, if I'm going to make 20% a year, great. I'm going to compare that to everything else I think I can make 20% a year for. I don't care that it's got a label on it today.
There are partnerships with that NASA and others to just with their reusable rocket and getting things up.
And one bad move by their leader could really kill a lot of contracts. So you've got key man risk here like you have with no other company. That's got to be there.
Okay, so you wouldn't touch it is what it sounds like.
Listen, the first VC investment was in 2008. They've done really well. Ontario Teachers, I think it's 2017 or 2019, when they made an investment in one of the series of SpaceX. They've been done very well. Buying it here now when it goes public, not sure.
Okay. All right, we got to leave it there, Larry. Thanks for coming in. Good to see you. And if you want to get hold of Larry, you've got a number of options from YouTube to LinkedIn. The website, of course, qwealth.com. Thanks for joining us today for Berman's Call. We will see you back here next Monday, but the close is coming up next.